trading floor. Sorry for the technical hitch. My computer's not behaving itself, but we're finally there, broadcasting from a rather overcast London at the moment. It looks like there's going to be thunder and lightning, but we're not going to let that get in the way of our cast this afternoon. So what we're going to discuss is what trades we're in, how they're doing, in addition to what is looking good on the horizon for the weeks and months ahead. And I just want to really give you a kind of quick potted view of the markets so that you can really take away some of the ideas and integrate it maybe into your trading plan as well. Okay, so if you've got any questions, do ask. I'm just going to have a look here to see who is in the room. I can see a few familiar faces here. Adam, yeah, good. I've recognized you. Pat and Amy, excellent. Welcome, Andrew and Al. Okay, so just have a quick look at the disclaimer here. For those of you who don't know me, my name is Robert Colville. I am the founder and CEO of thelazytrader.com. And yeah, I've been trading for about 8 years now and really did make every single mistake in the book several times over. I was greedy, I was fearful, I overtraded, blew up trading account after trading account in the earlier years, and stuck at it long enough to arrive at a style of trading which was trading the daily time frame and the weekly, of course, which really caused a paradigm shift in my trading. And since then I've really been working on being consistent. And the irony with my own journey is I've made a lot more from trading less and spending less time in front of the screen. And this allows me to trade for only a few minutes a day. It's very rare that I'm in more than like 3 trades at the same time, and often I set my trades up to set and forget, so that I'm in them for typically days, weeks, even months. I've just come out of a 6-month trade with pound Swiss. I'm going to talk to you a little bit more about that later on. But anyway, I'm pretty sure you didn't take time out of your busy week to hear me prattling on about myself. So without further ado, let's go into the markets, and I'm just going to go to E-Signal, which is where I've got lined up right now. I'm going to talk to you about the trades we're in. I'm currently short euro, euro dollar. Let's show you on the weekly time frame. I'm going to talk to you about the actual setup we took about 3 weeks ago. It was a very, very nice little setup, very easy. And if you're not identifying these yourself, I think you need to ask yourself why, because they make so much sense. The profit potential is pretty good. And you know what? Most people can, after knowing what I'm about to tell you, can do this themselves. So here we go. About 4 weeks ago, we identified this bearish pin bar reversal, rejecting the 1-spot-1-500 horizontal level of resistance here. We can see that euro, even though it's been in a range for the past year or so, it's at the top of the range. So it will represent one of the most efficient times or places in which to essentially sell euro dollar as it oscillates in this range here. Remember, it's still, but the bias is still downward trend. We can see here that we've got good order angle and separation on euro dollar. We can see this with the 20 being below the 50, the 50 being below the 200. There's still separation between them. The only slight difference is that the 20 and the 50 are moving sideways here, and that won't come as much as a surprise given that euro dollar has been ranging for the past year. So that was our context of the market. Then towards the beginning or mid-April, here we go. Sorry, my apologies, early May, we found this bearish pin bar reversal, which was our signal bar. The fact that it had a tail showed us that because we're trending this on the weekly, we can attribute this to a false breakout on the smaller time frames. It could have been on the 4-hourly, the hourly, or even the daily. We've got the all-important close below this horizontal level, and the false breakup represented by the tail. That's very powerful. What is more is the fact that we got bearish reversal divergence as well on the RSI. Here we had a lower high, and price we had a higher high. So that gave us the clue that things were going to go very nicely potentially for us. So we placed our entry just below the low to go short, and our stop loss above the high. We anticipated, or will anticipate, that euro would eventually go all the way down to the bottom of the range again. Okay, so this trade we had, how many pips risk? It was about 200 and say 250 tentatively, and we're targeting 860. I mean, that reward to risk is not bad. Okay, so 860 divided by 250, that's 3.4 to 1. That's risking 1%. But if we're risking 2%, like what we do on the weekly time frame, then you can stand to double that to 6.88%, risking 2%. And quite frankly, I mean, I know you might be thinking to yourselves, hey, this is on the weekly time frame. This is going to take ages to hit profit or even head towards a profitable outcome. But all you need is a few of these a year to really represent a very respectable return. Remember that 6.88% times 3 is 20.64%. And 20% is typically what Warren Buffett heads for or aims for. And yeah, he's one of the best investors in the world. So if you're getting 20% consistently a year, then you ain't doing that badly at all. Okay, so remember, this is just one example of a high probability trade. You might have to wait a little bit longer to get your outcome, but all you need is a few of these every year. But in the present, when you're trading, you're always thinking, goodness, I need to be in a trade, especially if you're an intraday trader or you're new to trading. You feel that if you're sitting on the sidelines and you're out of the market, that you're not gaining. Well, I'll tell you this much. If you've made this conscious decision not to trade because you don't see a setup which fulfills your entry criteria, then that actually says more about you as a trader than someone who is getting agitated and frustrated that they're not in any trades. Okay, so that is euro dollar, nicely going to plan at the moment. I just wanted to break this here. Okay, so there we go. We can move on from now and move on to the next. We're also short on the FTSE as well. At the moment, I'm not sure how much longer this is going to last, quite frankly, on the weekly time frame. You can see here that here, go back a few weeks, like so, we had just shy of a bearish pin bar reversal, rejecting 6400. If you took the Fibonacci retracement from the all-time high, and then we had that just about the 618, didn't overlap with the level, but remember the level it's rejected is actually a decent old support becoming new resistance. And we've got this thing called Brexit on the horizon as well. So I thought if we were nicely short FTSE and we were nicely in profit, and Britain did vote out of the European Union, and I really hope we do, by the way, then it's likely that the FTSE will nosedive out of fear. Markets and businesses and investors don't like uncertainty. Of course, if we remained in the EU, the markets will remain stable because they've adapted to the European Union. It's all they've known really for the past 30, 40 years, since the 1970s when the Maastricht Treaty. So that's stability. But if Britain leaves, then there's going to be, certainly in Britain, the pound is likely to crash, and so too is the FTSE. But of course, like we saw in the general election last year, the Tories versus New Labour, then it's very likely that we're going to get a result we didn't expect. I mean, the two parties were neck and neck before the election, and then the Tories won a landslide victory. And who knows, this could be the way for the Brexit and Remain campaign, both neck and neck at the moment. So, given that we had a bearish pin bar reversal here, we traded, break the low, stop loss above the high, and we were triggered nicely into the trade. And now we look like it's unfortunately coming back to test our stop. So, there's not much we can do about that. Our stop loss is a break even. We'll probably get pinged out for break even outcome. That's absolutely fine. On one hand, we could potentially have an inverse head and shoulders here. Left hand shoulder, head, right hand shoulder. But then the same was true on the way down as well. You can interpret this as left hand shoulder, head, right hand shoulder. The argument for long as well as short, based on head and shoulders formations, it's quite equal here. So you've got inverse head and shoulder forming into regular bearish head and shoulder. This pattern. Okay, So I'm just going to move on to oil. I know this is not currency per se, but we trade everything in exactly the same way. So let's just go on to that. I can find it. There we go, crude. Sorry about that, it took a while. So yeah, a few weeks ago, or so a few months ago now, all the way back here, we had mid-February we had a bullish pin bar reversal off a psychological number, $25 a barrel, and this bullish pin bar reversal represented a higher low. Furthermore, we had bullish reversal divergence on the RSI setting 6, where we have higher lows here, and this contrasts starkly with the lower lows price has made. This is a sign to us that the bulls are creeping back into the market, and they have been for a very long time here looking at this. So what we decided to do, given that also with oil seasonally mid-February, early to mid-February is a very bullish time for this commodity, and I'm going to show you a little tip here with equityclock.com. This is a very valuable resource which we use, which gives us how instruments have typically fared historically. Let me just get that over to you to show you exactly what we're seeing with oil. So we go to charts after going to equityclock.com. There we go. Sorry, they've moved it around a bit. Crude oil. So here we go. We saw crude oil. You can see how over the past 20 years, I know we're in a massive bear market at the moment, but typically we have the price action set up with a high low, the bullish pin bar reversal. That is a reversal if there ever was one. But this accompanied with the fact that we are seasonally bullish at this time of year for oil. There we go. Got the spike up. April, May, June, and we're plateauing off the end of May. So we go back to our chart, and what we did early February was place our entry above the high, stop loss below the low, and I just decided to have $50 a barrel as our target prior to a potential continuation to the downside. And let's see what price has done. There we go. It's gone all the way back up, and it's only this week has it hit $50 a barrel. And now if we get a, because that is a psychological number, 50, 50, 500, like 100, like 10, is a psychological line in the sand. It's a very significant number here. So this is why I'm now looking for shorts. Seasonality is where we're plateauing off, sorry, and we've got a significant psychological number and a horizontal level, and I'm just waiting for bearish pin bar reversal on the weekly time frame. Will we get it? Well, we're just going to have to find out. So let's move on. There we go. This chart looks like a bit of a mess now. We've got pound Swiss on the weekly time frame. Now this is one which has been very good to us. We've made, some of our clients have doubled their accounts, risking 2% on our Brexit hedge. I'm just going to give you a very quick synopsis of what we did. Very quick synopsis. All the way back in December, we sold here. Our entry just below the low, stop was above the high, and we took it all the way down to here. We scared out, making a fantastic gain, and we anticipated that, okay, there are fears that Britain was going to gain independence from the EU. And of course, like I just mentioned, markets don't like uncertainty. So the British pound was weakening against the Swiss franc, and the Swiss franc is essentially the same as the euro, given that they're very closely tied together. I mean, this trade, selling pound Swiss, is essentially the same as going long on euro GBP. All right, so this is why we didn't do both. And we took another position all the way back in March, early March, and then another position a few days later. We essentially really milked this trade for as much as we could. But now we are in this period of retracement. We're in a steep retracement here, as we can see, by a inverted head and shoulder. It's got the head, sorry, the left hand shoulder, that's the head, and the right hand shoulder. or is this just a complex retracement? We've got a three-wave ABCD pattern here, and generally with these harmonic three-wave patterns, we've got A to B equaling C to D. There we go. We have the completion point just coming up. Okay, so it's three-wave formation, A to B equals C to D, and we have 1, 4, 600. This point here also corresponds with a horizontal level. So we are looking for shorts at this point here, and we're not far away. We're only about 100 pips away. Less than that, 81 pips away. So we're going to be waiting for a sell signal on the daily or indeed the weekly time frame, but we're just waiting and see. Please bear in mind, we've been very actively trading this year. We've had a fantastic year so far. We've done so well across a range of currencies and commodities, and we haven't had a year like this in a long time, and a number of our clients have done very well off it as well. So that is what we're in. This is what we're looking at on our watch list as well. We haven't got much on the watch list, admittedly. At the moment, we've had, like I said, we've had a very busy time of it until now, but we are looking, seeing what the US dollar is doing as well as a termed currency. We find that trading the weekly time frame really does give you that kind of extra clarity in the market. You've got clearer market structure, and it just makes sense to go with that. I mean, just because you're trading a higher time frame, that doesn't mean that you're any less profitable than if you're trading a smaller, shorter term time frame. Okay, there's a lot of misconception again with people who think that because they're trading the weekly, that their work is, well, trading is far more boring, and it is absolutely. But I actually quite like that. I mean, if you're trading the 4 hourly, it makes sense to check the charts every 4 hours. If you're trading the daily, it makes sense to check the charts every day. But if you're trading the weekly, that is the ultimate sweet spot where you just have to analyze the charts once a week, and that is it. And there's nothing wrong with that. Okay, you can really be a hands-off trader. I know that before you're consistently profitable, it makes sense to obviously cut your teeth on the smaller time frames so that you can accelerate your learning. But when you really have got a kind of handle on what strategy works for you and your style of trading, then why not make it completely lazy and beneficial to you? Okay, there's nothing wrong with that. In currencies at the moment, not seeing too much clarity, but we are, for example, if we go to this one here, New Zealand CAD, we have been enjoying a few sells this year so far, and this is a market where we've just simply been selling the rally in a downward trend. Remember that until really recently, we've had like a downward trend in a range here. And what we've had recently is a complex retracement. Remember I said about ABCDs and what we're looking out for pound Swiss? Well, we're looking for it here with New Zealand CAD, and we did get the completion of it. And typically at the completion point, okay, it was a bit shy of it, to be frank, but still tested the previously respected level of dynamic resistance, in this case the 200 moving average, and we had a bearish pin bar reversal 2 days ago where traders would simply trade the break of the low here, stop loss above the high, and anticipate the continuation of this downward trending market. Remember that this is corresponding quite candidly with oil strengthening. Remember that we're selling the New Zealand dollar against the Canadian dollar. So oil strength is pegged to Canadian, Canada's economy, and this will cause a rise in the Canadian dollar for that reason. Okay, so we're still looking at sales here for New Zealand CAD. We're just simply selling the rally if, as and when we get it. Okay, there's nothing wrong with looking at some of these cross-currency pairs. A lot of people think that, hey, oh goodness, it's exotic. It's, why would we trade this when there are more popular ones? Well, let me ask you this: why would you want to limit yourself such choice? I mean, we trade what we see, not what we think on the chart. And if we've got a good potential buy on the chart, regardless of what currency it is or what instrument it is, you'll find that we actually apply the same methodology and logic to it as we would whether it's a currency, a commodity, or a stock. Again, a couple of weeks ago, we had this bearish pin bar reversal here, testing this horizontal level, 1700, big round number. Whenever we see pin bar reversals at horizontal levels, we tend to trade them because they act as very decent turning points in the market. All right, it's a sign that the market has tested it, it's rejected it, and it's now heading back the other way. But generally speaking, a lot of the currency markets are very choppy, and we don't really want to expose ourselves to this. Let's talk about pound sec now. We're waiting for this retracement. You can see we had the double top here, confirmed with the break of the head and shoulders right here. Price is about to test it, and what we're looking to do when it does is we're looking to sell if we get a bearish formation here, just in advance of 12 spot 50. Here we are. We're just waiting for price to come up, reject it, and to open and close below this level, and preferably have a tail, so we can trade it as a bearish pin bar reversal. Pound knock, we haven't quite got that. Look at this. Be interesting to see if it takes out the previous swing high. We already talked about pound Swiss, pound CAD. Trends are resuming. But what is interesting here, sorry, let's go back to the weekly, is if we see the 20 moving average below the 50 and the 50 below the 200, we're just looking to sell the rally and an upward trend, buy the dip. It's very simple. And that's all we look to do. Dollar sec. There we go. We're in this rectangular box here. So we're just simply waiting. I know we had a false breakout to the downside, and this was very difficult to trade on the smaller time frames. We got burnt, unfortunately. We had to sustain a hit on this level of support here. We're waiting for now simply for price just to simply come up to the top of this level of resistance so we can look to sell it again. Okay, price action when it's trapped in a rectangular box is fantastic to trade. It's very straightforward because it's simply you're trading the bounce within a confined space, and trades like that are very high in probability. So at the moment we're seeing the resumption of trends after a significant retracement. So given that the retracement in a number of pairs has been so steep and we haven't had an entry point, we're just waiting and sitting back until previous swing highs or swing lows have been taken out to confirm this, of course. Dollar yen. Moving more to the upside. Now this has been a very difficult one to trade of late. I can't really remember the last time I traded dollar yen. We had a decent sell signal here. Moving averages, unlike trend lines, can act as very good dynamic levels of support and resistance. The reason why I prefer them to trend lines is they're already drawn on the charts, so for that reason they're objective. There's less scope for the human being to essentially just make mistakes here. And as you can see here, unlike trend lines, moving averages only require one test in order for it to qualify as a dynamic level of resistance or support. And we had the test here, late April, had a new low made, had the retracement back to this 50 moving average again. We had the bearish pin bar reversal testing off it. That was a great potential sell entry. We have bearish reversal divergence as well on the RSI setting 6. And let's just see here. We've got, when it comes to bearish reversal divergence, we had price making a higher high, RSI making a lower high. So that's a sign that the sellers are coming back into the market. So what traders typically would do, professional traders, place their order just below the low of this bearish pin bar reversal, stop loss above the high. They would have been triggered into the trade, and then unfortunately they would have sustained a full hit on the daily time frame. Not quite yet a full hit, but that's always a warning sign when you see like a decent move in your favor followed by a bar similar kind of height coming back right back at you to stop you out. And for those people who are in that trade, well, unfortunately, it looks like that is happening. Hopefully, you would have moved your stop loss to break even. And typically, we have this rule. It's called a ratchet stop loss. That if, for example, you've risked a certain number of pips, in this case, 78, and you've made 78, as soon as you've made the equivalent number of pips profit that you've risked, not quite, then you can move your stop loss to break even. Because logically, you should always have your stop loss at a point where if it's hit, then the trade setup's invalidated itself anyway. And whenever that happens, whenever you do have that where the market's moved nicely in your favor, then suddenly it's moved against you, then that's a huge warning sign. And you need to be quite logical and protect yourself with that. Okay, so that is dollar yen. But ultimately, we've had such a good start to the year with lots of action. Anyone who wants to have an insight into previous trades we've taken, check out our YouTube channel and check out previous casts we've done on FX Street. But at the moment, as we're hurtling towards summer when the market's traditionally quite down, especially in August, there isn't really much going on at the moment. So, I mean, we, like I've mentioned to you before, those of you who know me, opportunities that conform to strategy rules are like buses. They can arrive at the same time or not at all. And it's the same with winning outcomes. It's the same with losing outcomes. So don't berate yourself if you're not seeing anything obvious. Just treat it as an opportunity to preserve your capital. A lot of people think, oh, goodness, they're not in the market. They need to worry. What am I missing out on? FOMO, I think they call it, that fear of missing out. But don't worry, okay? Sometimes it's the trades that you don't take are the ones that make you the money. And that I don't say that lightly, okay? Remember, from my own previous experience, the markets are designed, they're not designed, sorry, they're there to tempt you. And this is why a lot of people get burnt. It's no surprise that 90% of people who try their hand at trading financial markets with no education ultimately crash and burn. I remember an off-the-record broker confession a few years ago, and he kind of said to me, he's a B-book broker, surprise, surprise, that 90% of his clients lose 90% of their money in 90 days because they absolutely have no idea what they're doing. Okay, so before you're at the point of consistency, my advice to you is to simply be cautious and be disciplined. Remember that Euro trade I just told you about at the beginning of the webinar? That was such an easy looking trade in plain sight, and the profit potential was 6.6%. It was a very easy looking target to gain, given that the Eurozone is pretty much a basket case anyway. And yeah, all you need is several trades like that a year, and you can be well on your way to being a full-time trader, or reaping the full-time profits that trading can gain you, really trading very minimally and keeping things very tidy and low maintenance. And there's no reason why you can't have trading to do that for you as well. I mean, a lot of you have day jobs, I would imagine, and you're using trading as a supplementary income. And I would never recommend to someone who's just discovered trading to ditch their day job, because that would just be wholly irresponsible, because nothing is ever guaranteed in the markets. Okay, so that concludes our scan of the market. And what I really want to talk to you about is a potential opportunity which I'm offering people like your good selves who've taken the time off work. You're obviously keen on the idea of trading, and I just want to give you the opportunity to transform your trading into a carefree, relaxing hobby. I mean, a lot of people experience it as a time-consuming, stressful, loss-making mistake, but I want you to experience it as a carefree and relaxing hobby. Trading from as little as 10, 15, 20 minutes a day. The difference between money working for you and you working hard for your money. And in collaboration with FX Street, I'm going to give you access to the Ultimate Program valued at $1,997 US. And what I'm going to do is give you 1 month's test drive for $30. And for that, it's a huge saving. You're going to get access to all of our trade ideas, all of our weekly and monthly market analysis. You'll get access to both basic and advanced strategies, which are tradable in all markets. You'll have access to some of our cutting-edge bonus programs, like the Trade Voyager pattern recognition software and the Trader Hypnosis audio course. Hours and hours of training videos, discounts, prizes, competitions, We've got 40 years experience between us. So for those of you who really want to take advantage of this, then just simply go to thelazytrader.com/forex trading, buy the ultimate program, read the terms, type in the promo code FX Street, and there you will have your discount, $30. Okay? And that's that. Any questions, please do drop me a line. But for now, I thank you for all coming. Take care and happy trading.